Month is 2/3 over. We've got less than 2 months before New Year's. And what do I always say? Well, first of all, it's Friday. So happy Friday. What do I always say? Let's get into it right now. Now, looking at the futures market, the market's going to open up in a little over an hour. You could see that the Nasdaq 100 is rallying again, while the S&P, the Dow, the Russell is lagging behind. That's telling us that I'm going to give you guys a really good way to view the market. Whenever you see the Nasdaq 100 rallying, that means economies getting fearful of COVID once again, because that's where the stay-at-home stocks are, Nasdaq 100. And if you see the Dow or the Russell or the S&P rally and the Nasdaq lag behind, that means that there's more confidence that the vaccines are winning over. So if the Nasdaq leads, that means people are getting more fearful that there's more COVID and less vaccine relief. And if Nasdaq is down and the Dow and Russell and S&P are up, it typically means that the vaccine and the vaccine is winning over and not the fear of COVID. So again, over the next month or so, or maybe even longer, because we're just now getting into the winter months, you're going to have to kind of get a feel for the market that way. Overall, I'm not extremely bullish on the Nasdaq 100. I'm seeing a lot of the stay-at-home stocks begin to soften. I'm seeing the market capitalization broaden. I'm seeing a lot more wider cap stocks, the non-stay-at-home stocks rallying. But at the same time, I'm also seeing some of the stay-at-home stocks up. So don't throw the baby out with the bathwater. The market cap is just getting broader. We're still fearful, but we're hopeful. So the market capitalization is not just pushing stocks higher like tech, like the internet stay-at-home stocks, and the other type of stocks that we were bullish on, like tech and healthcare, vaccine stocks 4 or 5 months ago. Now we're seeing more retail, industrial, basic material, travel stocks, packaging stocks. So overall, I'm not as bullish on the Nasdaq 100 because it's just way too much too soon. And again, if you look at the momentum levels, we're near nosebleed levels right now on the 200-day, and the 50-day is similar. So again, I would be very, very cautious. And if you are going to go into the Nasdaq 100, try to find stocks that are not overextended. And if you follow along with what we say, you'll have no problem doing that, because I point all this out to you on a daily basis. Now, yesterday we had jobless claims, and I hate to say I told you so, but look at this. We're still, yes, we're below the 4-week moving average, but it doesn't mean anything because the number is still in the 700s. We've been between 1 million and 700,000 now for like 8 months. It's got to go lower, because what's going to happen if economy picks up but jobless claims don't go lower? That means people aren't going back to work, which means the recovery is going to be very, very limited. So I need to see this number fall below 700 like yesterday, and it's not. So while the number is in line with expectations, or a little bit worse than the expectations, the worst part of it is, if you look at it on a longer term basis, we're still hovering around the same number we were hovering 5 months ago, and infection rates are going higher. So this is not a good sign right now. This is telling us that defensive stay-at-home stocks may come back up if the vaccine isn't going to be coming out in time. Basically, what I'm trying to say is the world is right now trying to balance two things. 6 months ago, it was, oh my God, what's going to happen? What's going to happen? Healthcare stocks, tech stocks, stay at home, stay at home, stay at home. There's no vaccine on the horizon. Now things are changing. One day, oh, we're hopeful vaccine's going to come out. The next day, not yet. Infection rates are going up. So you have this battle between the good and the evil, if you want to look at it that way, the vaccine or fear versus the expectations that the COVID is going to come out. And based on the jobless claims, the numbers are bad and weak. And it's telling us that we may be in for a rude awakening if the numbers don't get better. Because, folks, if people don't work, how can the economy get better? And again, 742,000 claims. And if you look back 6 months ago, 5 months ago, 4 months ago, the numbers were very close to this. So I'm a little bit disappointed, to say the least. And that's another reason why the market is not prepping up right now. Now, let's look at global data. I wanted to kind of give you a different perspective to start with. I usually start with global data, but I kind of wanted to show you what's really driving the market. It's this, we're at a crossroads right now. It took us a while to get there, but we're at a crossroads right now. And door one is going back and staying home, and door number two is vaccine. And we're kind of going back and forth right now and trying to figure out which door we're going to go to, because it looks like we're going to go into one or the other. It's not going to be a little bit of both. So keep that in mind, unless like the vaccine comes out tomorrow and it doesn't look to be the case. It looks like we're still not going to get it for several months. So there's a good chance this winter could be a complete replication of what we saw last winter. The February, the March, the May months, where it was a stay-at-home environment, lots of lockdowns, internet, cloud computers back up. It could be that way. It's not looking right now. It looks like it can go either way, and I'll keep you posted. But either way, let's talk about global economy. Global shares were mixed in a muted trading Friday amidst continued conflict between current worries over the worsening pandemic and the optimism that the vaccines will rescue the economy in the future. I think that sentence right there summarizes exactly what I've been trying to tell you for the last several minutes. That's really where the market is at right now. It's literally like sitting and waiting. This door or this door, this door or this door. We haven't had an environment like this in quite some time. We've been kind of fearful, and hopeful, but now we're finally there. And now, as I say, we're finally starting to ask the right questions. And that means the market has to assimilate going this way or this way. And it's having a hard time doing that right now for obvious reasons, because we're like a month away from getting this info. We're like a month away from a close down. We're in a really interesting place. And to add on top of the uncertainty, we still don't know 100% if Biden or Trump is going to be the new president. I mean, it looks like Biden, but I wouldn't rule Trump out. So again, the markets are a little perplexed and a little confused right now. And you need to understand that and trade that way. The market's November rally had slowed this week as fears about the economy buckling in the near term collide with the hopes that stronger growth will arrive next year once effective COVID-19 vaccines become available. As I said, we're literally like, you know that image of a guy and he's sitting there in front of two doors or two paths? That's where we're at right now. Infections, hospitalizations on the rise across the U.S. Governors and mayors are grudging issuing mask mandates, limiting the size of gatherings. From what I understand, New York closed their public school yesterday because the threshold level was past 3%, banning indoor restaurant dining, closing gyms, and restricting the hours and capacity of other businesses. Democrats and Republicans in Washington are still stymied in their attempts to deliver another dose of financial support. That has the specter of a bleak winter looming for both healthcare system and the economy. I'm telling you, folks, the markets are perplexed right now. Markets usually are not perplexed, but I'm telling you right now, the markets are perplexed because we're literally at a crossroad. University of Oxford scientists expect to report results from the late-stage trials of the COVID-19 vaccine they're developing for AstraZeneca by Christmas, according to researchers. Already this month, pharmaceutical companies have offered data suggesting other vaccines. Pfizer said Friday it's asking U.S. regulators to allow emergency use of the COVID vaccine in developing with BioNTech, starting the clock on the process that could bring limited first shots as early as next month. And again, crude oil, $42, a little bit below the price that U.S. frackers pay for crude oil. Now, I wanted to show you something interesting. I wanted to show you filters. Now, if you look at the top 10 sectors right now, on a cumulative basis, we still got industrial and basic materials leading. And I've been talking about that for months, literally for months. But if you look at the 1 month, this is the last 30 days, you'll see that energy and financial are moving ahead. Now, the reason energy is moving ahead is because, remember, energy has when you're looking at this broad sector, this is including the evergreen, the bioenergies, the renewable energies with traditional energy. It doesn't separate it. And non-traditional energies, like NEE, for example, they have been just going off the roof lately. They've been going pretty good. Look at that, near all-time highs. And if you look at traditional energies like, how about we look at Exxon? That's a pretty traditional energy. It's still near the bottom. So I don't want you to get confused and think that all energy is moving higher. They kind of are, but traditional energy is still on the floorboard. And I'm about to short most of those stocks. But evergreen energy, because of Biden, is looking a lot better. Also, financials are starting to look up. Now, you got to be very, very careful with financials because the investment bankers are going up. Traditional banks are slow to go up. So again, with these two sectors, you've got to be very, very careful because they're kind of split between two different subcategories. So you've got to be careful. On the other hand, I do like the entire industrial and the basic materials sector. And on that note, I want to show you a low-risk stock that I'm liking right now. The name of the stock is Avery Dennison. We've talked about this stock before several times. It's a strong buy, and it's showing a 10-day high, a 90-day high and a 10-day low. And if you look at the company, it's labeling material, labeling solutions for apparel. Remember, people are buying things online right now like there's no tomorrow. And they need these office supplies, materials sent. So you've got office supplies, packaging, basic materials, and you're in a consumer packaging. Look, serves customers in the consumer packaging, graphic display, logistics, apparel, industrial, and healthcare industries. All those tests you're going to be getting, those COVID tests, all those packages you're getting from Amazon, labels. That's what this company does. It's an amazing company. It's doing really well. Look at earnings surprises, estimates, surprises. Look at ratings. 5 strong buys. The profile of the company. Look at the returns. Dividends, 68%. And this is a low-risk trade. Also, earnings per share growth previous quarter, previous year. I like these numbers a lot. I like this stock. And again, what I would do in this case, let me just bring it closer to you. I would go long right around the 147.80 level, 148 level, and I would put a stop loss right at the 144.50-ish level, right below this low right here. And I would take profit right around the 159 level. And I think we're going to see another one of these patterns or these patterns right here because I don't see the stock moving lower. I see it actually breaking out, especially after this long congestion pattern. Another stock that I'm looking at, I'm starting to like it, is Expedia. And this is a travel service stock. The stock is completely bucking the trend right now and is taking out the high, filling in the gap from last February. That's very, very positive. And it's also telling me that people are starting to look ahead past COVID a little bit. Remember what I said, the S&P is getting broader. Travel stocks, labeling stocks. It's not just all healthcare and computer stocks. So again, I like this stock. I like the congestion it's seeing. I like the fact that it's not pulling in to fill the gap right here. And I would be a buyer at these levels, and I would put a stop loss right here, like the 114 level. If it starts filling the gap, it's no good. Now, before I let you go, I've got something for you, and it's Friday. It's a big day. There's a new takeover that could change the stock market forever, folks. Wall Street has been dominating the majority of the stock market with their algorithm trading tools, triggering massive buying sprees and sending stocks like Zoom, like DocuSign, and Amazon soaring. Soaring. Now, these massive funds have invested millions of dollars in these high-tech algorithms, an advantage the Main Street investors obviously cannot afford. It's put complete control in the hands of Wall Street. That's right. But I'm about to share a top secret discovery with you. I call it Storm, S-T-O-R-M. And it could turn you 30 times the S&P, 30 to 50 times returns that you're getting from the S&P every single year on average. We've seen nothing but triple and quadruple digit gains. We closed out a trade. It was supposed to be a week trade. We closed it out after 2 days with triple digit gains times 4. We literally made 3 or 4 100% plus returns in 2 days. And that's the kind of market environment Storm is predicting right now. All you've got to do is click on the link below and get all the details and discover my top secret discovery. You've got to check it out. And also, don't forget AVY and EXPE stock. Have a great weekend. Put some feedback for me in the summary below. I want to get some feedback from you guys. Good, bad, ugly, I don't care. Give me some feedback in the comments, and I